Paul Nasr, a senior managing director in capital market services at Morgan Stanley, was reviewing the performance evaluation data for Rob Parson, a star producer at the firm. The evaluations were among the most negative Nasr had ever seen. Although Parson was a top revenue generator, his difficulty adjusting to the Morgan Stanley culture and his interpersonal issues were significant problems. Morgan Stanley's vision. Morgan Stanley, a leading U.S. investment bank since 1935, was undergoing an organizational renewal under the leadership of John Mack, who became president in 1993. The firm was transforming into a one-firm firm, with a mission to be the world's best investment bank, committed to exceptional performance, innovation, and integrity. The mission emphasized the importance of teamwork, innovation, and treating employees with dignity and respect. Challenges with Rob Parson. Parson was a strong revenue producer and had generated substantial new business for the firm. However, he was known for being sharp-tongued, impatient, and difficult to work with. Nasr understood that Morgan Stanley valued team players, but he also felt responsible for building the business and believed Parson was crucial to that effort. Despite Parson's performance, his negative evaluations made it difficult to promote him to managing director, a position Nasr had almost implicitly promised when recruiting him. Capital Market Services, CMS. The Capital Market Services division at Morgan Stanley was created to make the firm more responsive to client needs. This interdisciplinary entity linked the investment banking division with the sales and trading arms, aiming to provide clients with focused attention and service. CMS professionals were organized into market coverage areas and were expected to generate business and work with corporate finance professionals, product specialists, and other divisions. Market coverage professionals. Market coverage professionals, like Gary Stewart, needed to understand the business in their industry, develop relationships, and have good market judgment. They had to understand their clients' needs, work with product specialists, and synthesize market, product, and client information to create business opportunities. Working with clients was only part of the job. Market coverage professionals were interdependent with other professionals at the firm. They needed to collaborate with product specialists and market-side experts to deliver products and understand client needs. The role required balancing market knowledge, product expertise, and client relationships. Paul Nasr. Shaking up Morgan Stanley's culture. When John Mack became president of Morgan Stanley, he wanted to change the company's culture by bringing in new talent. He recruited Paul Nasr, a well-respected banker with nearly 20 years of experience. Nasr was known for building a strong capital markets business at a competing firm and soon took on a leadership role at Morgan Stanley. Nasr noticed that many investment banks focused more on individual professionals than the company's culture. However, at Morgan Stanley, the company's reputation and integrity were paramount. Nasr identified that Morgan Stanley had a weakness in capital markets services for financial institutions, such as banks and insurance companies. Knowing the importance of this market, Nasr sought to strengthen Morgan Stanley's presence. He believed that the firm could not ignore the significant market share generated by these institutions. To achieve this, Nasr recruited Rob Parson, a young banker with a successful track record in financial services. Parson's energetic and entrepreneurial spirit made him the right fit for this challenging role. Rob Parson, an unconventional hire. Rob Parson had built strong relationships in the banking and insurance industries over his 10-year career. Despite his unconventional background, Nasr saw potential in Parson. Parson did not fit the typical Morgan Stanley mold, having dropped out of college before eventually earning an MBA from the University of Southern California. He had a knack for hustling and quickly made his mark on Wall Street. Parson initially hesitated to join Morgan Stanley but was convinced by Nasr's reputation. He admired Nasr's client skills and saw him as a role model. Parson joined Morgan Stanley as a market coverage professional in the capital markets division, focusing on financial institutions. He was given the title of principal, with the promise of a fast track to managing director if he performed well. Challenges and frustrations. Parson's new role at Morgan Stanley came with significant challenges. The position had seen high turnover, and the firm had little capital markets business with its important investment banking clients. Parson found the situation worse than expected, with dramatic turnover in trading coverage and an understaffed bank group. High interest rates further compounded the challenges. The financial services segment was highly competitive, requiring aggressive characteristics. Parson had to be resilient and not easily discouraged, as clients often engaged in cutthroat negotiations. Nasr supported Parson, understanding the constraints he faced. However, Parson's approach often clashed with Morgan Stanley's consensus-building culture. Internal conflicts. Parson's style created tension within the firm. Colleagues described him as volatile and abrasive, lacking team player skills. Nasr tried to mediate by advising Parson gently, but the problems persisted. Parson found the firm's focus on form over substance frustrating and questioned whether his results mattered more than his unconventional background. Despite these conflicts, Parson was praised for his ability to create business opportunities and generate substantial revenues. He secured first-time business with over 10 clients and helped Morgan Stanley climb from 10th to 3rd in market share in the financial services sector. Nasr acknowledged Parson's client relationship skills and saw him as a valuable asset externally. The dilemma. Nasr faced a dilemma. He had hired Parson through a personal connection, which led some to perceive favoritism. Nasr believed in treating Parson fairly, without compromising Morgan Stanley's culture of teamwork and integrity. He reflected on how he could have better communicated the cultural differences to Parson if he had been at Morgan Stanley longer. Nasr recognized Parson's unique drive and ambition but also noted the disruption he caused. The challenge was balancing Parson's valuable contributions with maintaining Morgan Stanley's collaborative environment. Nasr needed to decide how to address Parson's performance and the issues it raised while upholding the firm's values. The performance evaluation process at Morgan Stanley. When Mac became president of Morgan Stanley, he introduced a significant change, a firm-wide, 360-degree performance evaluation process. This new system aimed to transform the firm's culture by evaluating every professional based on feedback from their superiors, colleagues, and subordinates. Mac believed that by changing the criteria for evaluation and compensation, employees would be encouraged to embrace teamwork, cooperation, and cross-selling. Goals of the new evaluation system. The new evaluation process had two main objectives. Cultural change, to promote a culture that values teamwork and cooperation. Developmental feedback, to help employees improve in 4 key areas: market, professional skills, management and leadership effectiveness, commercial orientation, and teamwork, one firm contribution. Evaluators were asked to provide detailed comments on an individual's strengths and weaknesses, using specific examples. Despite being in place for 2 years, there was still some confusion about its practical implications. One managing director noted that while being a team player was valued, the criteria were not explicitly defined. Rob Parson's self-evaluation. In his self-evaluation, Parson acknowledged the need to be more patient and less aggressive internally. He admitted to not promoting his achievements well enough within the firm and expressed a desire to better communicate his successes with a wide range of clients. Parson's long-term career goal was to hold a senior leadership role focused on client relationships, away from day-to-day administrative duties. Nasr's dilemma. As Nasr reviewed Parson's performance evaluations, he faced several critical decisions. Promotion consideration. Whether or not to promote Parson to managing director. Evaluation and development summary. Completing this summary would be crucial for Parson's annual performance review and would be reviewed by the promotions committee if Parson were a candidate for promotion. Feedback session. Having a conversation with Parson to explain his decision, provide feedback, and offer developmental advice. This session's effectiveness would impact Parson's future performance and his decision to stay with the firm if not promoted. Nasr knew the importance of this evaluation process. His decisions and feedback would not only affect Parson's career but also influence the broader goal of fostering a collaborative and team-oriented culture at Morgan Stanley. The impact of the 360-degree performance evaluation at Morgan Stanley. The introduction of the 360-degree performance evaluation at Morgan Stanley was a bold move aimed at transforming the company's culture. Mac, the president, believed that by changing how employees were evaluated and compensated, the firm could foster a culture of teamwork, cooperation, and cross-selling. This evaluation process was comprehensive, involving feedback from superiors, colleagues, and subordinates, and focused on 4 key areas: market, professional skills, management and leadership effectiveness, commercial orientation, and teamwork, one-firm contribution. Despite the ambitious goals, the new system faced challenges. 2 years into its implementation, there was still confusion about what being a team player truly meant in practical terms. This lack of clear criteria made it difficult for employees to understand how to align their efforts with the firm's expectations. Rob Parson's experience highlighted some of these challenges. In his self-evaluation, Parson acknowledged areas for personal growth, such as developing more patience and improving his internal communication about his successes. He had a clear long-term goal of moving into a senior leadership role focused on client relationships rather than daily administrative tasks. Nasr, tasked with evaluating Parson, found himself at a crossroads. He had to decide whether to recommend Parson for promotion to managing director and how to deliver feedback that would be constructive and motivating. This decision was crucial not only for Parson's career but also for retaining talent within the firm. The effectiveness of Nasr's feedback session would significantly impact Parson's future performance and his decision to stay with Morgan Stanley if not promoted. It was a delicate balance between recognizing Parson's achievements and guiding him towards aligning more closely with the firm's cultural expectations. In conclusion, the 360-degree performance evaluation process at Morgan Stanley was a step in the right direction for fostering a collaborative culture. However, its success depended heavily on clear communication of expectations and constructive feedback. As the firm continued to refine this process, the goal was to ensure that all employees had a clear understanding of how to be successful within the new cultural framework. This would not only improve individual performance but also drive the overall success of Morgan Stanley.